U.S. stocks finally get a key boost. Which sectors will benefit most in the rebound? Are you ready? After suffering its worst week since April, the U.S. market finally received some critically good news today. It appears an agreement has been reached to end the federal government shutdown. This political drama, which has dragged on for 40 days, is finally drawing to a close. As a result, stock futures in both Europe and the U.S. surged today. Asian markets also posted significant gains, and the crypto sector experienced a strong rebound. In this video, we're going to break down exactly which sectors are positioned to be the biggest winners from this expected rebound. If you find this useful, don't forget to like the video first. Now let's dive in. Fundamentally, the recent stock market decline wasn't caused by a single factor. It was the result of a combination of market liquidity concerns, high AI valuations, and uncertainty around Federal Reserve policy. The current expectation for a rebound is primarily centered on the release of liquidity that will accompany the end of the shutdown. In the short term, all sectors will benefit from the hundreds of billions of dollars flowing back into the system. However, the following 5 sectors are among the most sensitive to liquidity shifts and stand to gain the most. 1. High-tech growth stocks. This was the hardest hit sector during the recent liquidity crunch. The core characteristic of tech growth stocks is that they are long-duration assets, valued more on future potential than immediate profits. When market liquidity improves, the discount rate applied to those future cash flows decreases, significantly boosting their valuations. This is why potential Fed rate cuts have an outsized impact on these stocks. As I mentioned last time, this liquidity drain was effectively like a 100 basis point hike by the Federal. Therefore, when that liquidity is released back into the market, tech growth stocks will be among the biggest beneficiaries. 2. Non-essential consumer discretionary. The end of the shutdown means that roughly 2 million federal employees will resume receiving their salaries and resume spending. Furthermore, they will receive back pay in a lump sum. This will directly trigger a short-term spending catch-up effect. Simultaneously, government procurement and project spending will restart, which will benefit the entire consumption chain, particularly services, transportation, and travel. Additionally, discretionary spending is highly correlated with credit conditions. Interest rates on car loans, mortgages, and credit cards will decline as banks' overnight funding costs decrease, giving consumers more room to spend. 3. Semiconductors and advanced manufacturing. Semiconductors are a classic capital-intensive industry, highly dependent on the cost of capital. Consequently, they are often one of the first sectors to rebound when liquidity hits a bottom and industrial capital expenditure begins to recover. Within the prevailing AI narrative, once liquidity is released, semiconductors will receive a dual boost from both improved capital flows and market sentiment. However, it's worth noting that while the reopening is a key catalyst, concerns over stretched AI valuations and Fed policy uncertainty haven't fully vanished. The AI bubble narrative will likely remain a lingering worry in the market, warranting caution. 4. Fintech. As a leading indicator for risk assets, the entire fintech sector was battered during this downturn. But with a short-term liquidity fix, investor risk appetite is expected to return. Take the crypto sector, for instance. The most direct impact will be on trading volume. As retail and institutional investors re-enter the market, fees from custody, market making, and derivatives will amplify accordingly. The end of the shutdown and improved macroeconomic sentiment will further unleash this rebound momentum. Currently, both the crypto and broader fintech sectors are already showing signs of a pre-market breakout. 5. Real estate. Real estate assets are characterized by stable cash flows and solid underlying collateral, making them particularly attractive in the early stages of economic recovery and during periods of improving liquidity. Their valuations tend to expand. When macro signals shift from risk-off to improvement, a valuation repair for asset classes like real estate becomes more likely. With the shutdown ending, fiscal spending resuming, and economic expectations brightening, real estate will see indirect benefits. For example, the restart of public works and infrastructure projects will boost demand for residential, commercial, and logistics properties. After outlining the sectors most likely to benefit from the rebound, I must add a final note of caution. While liquidity and market sentiment have seen a short-term repair, the market's core narratives regarding expanding corporate EPS growth and the sustained, high expectations for AI-driven economic transformation still need further validation. Furthermore, the Fed's interest rate decision in December remains a sword of Damocles hanging over the market. Uncertainty persists, so everyone should be cautious about chasing the rally at elevated prices. Alright, that's all for our discussion today.